There is a persistent belief among retail traders that selling covered calls is one of the safest ways to generate consistent, high-yield annualized returns. The strategy promises steady weekly premium income simply by selling options against shares you already own. Retail trading educators frequently point to this mechanism to make aggressive financial promises, heavily marketing systems that generate annualized premium rates well above 30%. Financial author Heather Cullen examined these claims, specifically critiquing the use of deep-in-the-money options to achieve those massive advertised yields. Because deep-in-the-money options require significantly less upfront capital than owning shares outright, the premium collected appears mathematically huge as a percentage return. However, utilizing that leverage severely magnifies the downside of the strategy's primary requirement, a rigidly capped upside. Cullen establishes a strict, unyielding rule for evaluating these option-selling systems. The more you bet, the more you give away. Truncating the right tail of your return distribution, cutting off the largest potential gains, systematically degrades long-term portfolio growth. To prove this, we can look at a rigorous 156-week mathematical backtest that entirely dismantles the illusion of the weekly paycheck. For a quantitative trader, the data reveals that underperforming with covered calls is not a product of bad market timing. It is a systemic mathematical flaw baked into the strategy itself. When tested across actual market conditions, these seemingly safe weekly income strategies mathematically guarantee underperformance against a standard buy-and-hold approach. To understand the failure of the strategy, we have to start with a bedrock axiom of the stock market. Long-term gains do not occur in smooth, even increments. The vast majority of historical market wealth is generated by sudden, sharp upward rallies that happen in brief, unpredictable windows. When a trader sells a covered call, they collect a small, fixed cash premium up front, but they contractually agree to cap their potential profit at a specific strike price. The exact moment a market breakout occurs, the strategy turns against the trader. If the stock crosses that strike price line, the upside is gone. Every single dollar of upward movement beyond that threshold belongs entirely to the option buyer. Cullen designed a backtest spanning 156 trading weeks on the S&P 500 ETF, the SPY. The test simulated selling covered calls every Monday morning that expired 5 days later on Friday. This table outlines the results for strikes set just 1% out of the money. Look at the assignment frequency. The data shows the shares were assigned or called away 35.9% of the time. More than a third of the time, the underlying asset was surrendered. The traders sat on the sidelines, missing the very rallies that drive index growth. We can compare that lost capital to the income generated. The total premiums collected over 3 years amounted to an estimated 61.5%, but the cumulative upside surrendered was over 70%. That's 70. Looking at the 2% out of the money column on this second chart, we see that while assignment drops, the estimated premium collected plummets to 16.6% over 3 years. As the frequency of assignment goes down, the premium income collapses to levels that barely match ordinary market returns, rendering the active management of the strategy pointless. Even on a broad, relatively low volatility index like the S&P 500, capping rallies mathematically guarantees that you give away more upside than you ever collect in weekly premiums. If the math fails on a broad index, we need to test what happens when we apply it to individual, high-volatility tech stocks. The quantitative relationship is straightforward. The higher the underlying asset's volatility, the more destructive a capped upside strategy becomes to your total return. Apple is frequently cited by trading educators as an ideal candidate for covered calls, despite its well-documented price volatility. Looking at Apple's backtest for 1% and 2% strikes, the net effect shows catastrophic underperformance, -64 and -47. The middle column is grayed out because Apple options lack the precise 1.5% strike granularity of the SPY. The valid Apple results demonstrate that applying this strategy resulted in underperforming a standard buy-and-hold approach by approximately 20% annualized. The data becomes even more severe when applied to the most extreme test case in the dataset, Tesla. This table illustrates what happens when immense volatility collides with a fixed fact. On the bottom row, the net effect numbers plunge to between -193 and -205%. The raw mathematical reality is that Tesla traders executing this system underperformed a simple buy-and-hold strategy by roughly 70% every single year. There is a severe irony here. These highly volatile, aggressive growth stocks are routinely pushed by educators as the best possible targets for income generation. But the intrinsic value of high-growth assets comes strictly from massive sudden price spikes, the exact rallies that the covered call trader is contractually slicing off and handing away to someone else. As an asset's growth potential increases, the structural flaw of capping your upside becomes exponentially more destructive to capital accumulation. If the quantitative data so definitively proves a negative drag on returns, we have to ask why covered calls remain incredibly popular among retail traders. The answer lies in psychological comfort. In flat or slowly rising markets, repeatedly collecting small premiums feels consistent, calm, and highly controlled. Traders experience a long series of frequent tiny wins, but cognitively filter out the fact that those wins are entirely dwarfed by rare, massive opportunity losses. The immediate dopamine hit of successfully securing income most weeks successfully masks the invisible reality of sacrificing compounding, long-tail market events. This cognitive dissonance sustains a massive, highly lucrative commercial industry built entirely around selling this exact illusion. Top retail trading educators have amassed hundreds of thousands of followers, building communities strictly around executing these weekly option-selling trades. And they charge exorbitant rates for the privilege. Entry-level software packages cost $4,000, while elite annual coaching tiers run as high as $30,000 a year. The ultimate irony is that traders are paying heavily out of pocket to learn a mathematical framework that guarantees they will underperform the baseline market. These educational programs successfully sell the concept of a weekly paycheck by intentionally ignoring the hidden structural cost of upside surrender. Mathematically, the covered call strategy does not generate free yield. It is simply a highly efficient mechanism that systemically transfers your portfolio's wealth-building potential directly back to the market.